One is literally betting 25% of their portfolio, let's say hypothetically in this example, on one house, on one tenant, on one thing. And so there's a lot that can go wrong. Hey everyone, this is Ian. I'm back with another video about dividend growth investing. So I really appreciate all of the wonderful questions from all of you subscribers out there, and I want to answer and respond to one of the questions today. This is a very recent one. It was a question when I did my video about real estate investment trusts, or REITs. And the specific question goes like this. Hey Ian, I really like this idea of investing for cash flow and income. I want income, passive income coming my way. I want it to cover my living expenses. And Ian, I'm really drawn to real estate. I like real estate. It's something that's tangible. I understand real property. I like real estate. And I can totally identify with that. I happen to be in the commercial real estate industry myself by profession. And so then the subscriber went on to ask, hey Ian, I'm trying to weigh the pros and cons here. I'm thinking about taking my money and investing in a real estate investment trust, or I'm going to take my money and actually go out and buy properties, or maybe start with one property. And in particular, I think the subscriber had mentioned a single family home, something of that magnitude that the subscriber could then rent out and receive cash flow and passive income from that rental property. So today's video discusses this very topic. I want to compare and contrast real estate investment trusts versus rental properties, tangible rental properties where you're not going through a trust, you're literally buying and investing in physical real estate with the goal of renting it out. And there's pros and cons of each, and certainly I cannot speak to this subscriber's particular situation, but what I'm going to do is approach this question hypothetically. I'm going to approach it, hey, if I in my own shoes, just as I'm approaching anything in investing, how would I weigh the pros and cons? And so let's jump right into it. I'm going to get out my notebook here. Took a bunch of notes, as always. And first point goes like this. Before getting into individual properties in the world of real estate, it's very important to consider one's overall portfolio size. And for my particular risk tolerance, I don't like to have too many eggs in one basket. I like to diversify. I like to have a variety of different holdings, different industries, different stocks. I like to diversify. And so also at the same time realizing to go out and buy a single family home or a condominium and rent that out, that's a big ticket purchase. It's expensive. And so the first thing I would do is just look, how much money do I have to invest in total? What's the aggregate size of my portfolio? And if my portfolio were not at least in the several hundreds of thousands of dollars, meaning maybe $200,000-$300,000 range, I probably would not consider for myself investing in a property to rent it out, just because the down payment alone on that property is going to be pretty substantial, and it certainly depends where one is in the country. I guess I'm speaking more from a California-centric perspective, just being in the San Francisco Bay Area with real estate prices very expensive. But that being said, I think my perspective is a good one because in general, when it comes to real estate, as with stocks, it's important for one to be selective and to pick the markets that are the growing markets, the exciting markets, the markets that will do well in good times and bad times. And Greater San Francisco Bay Area has had that attraction, that pull for decades upon decades. And so I like this market. There's other obviously wonderful markets throughout the country and throughout the world. But I think if my portfolio were at least not in the hundreds of thousands, I wouldn't be ready. I wouldn't be ready yet for investing in residences and condominiums for the purposes of renting them out. And so that would be question number one. How much money do I have? And if my portfolio were smaller than that amount, certainly if I wanted that exposure to real estate, I would look at real estate investment trusts as a wonderful alternative where the barriers to entry are basically no barrier to entry. Investors of all sizes could participate. So let's see, what else do I have? This goes with the first point. It's a concentration of risk. In my overall financial strategy, my dividend growth portfolio, I own over 30 stocks. They provide me with a huge amount of cash flow. I've been building this portfolio for decades, and I've been investing for over 20 years. And so I would say I probably have too many stocks. My portfolio of 30 stocks, 30 plus stocks, is probably too many for the average dividend growth investor. That being said, there's a story behind why I have so many stocks, and the story goes really like this. If any one of my positions faces adversity, it will not impact the overall pie. My dividend income, because of the diversification, is rock solid. Now, and I don't have too much concentration of risk in any one position. Now, if I were to invest in a single family home with the goal of renting it out, I would really have to analyze how much money I'm putting into that as a percentage of my portfolio. And again, if it were too much, I would see that as a huge concentration of risk. Now, you may be thinking, hey, Ian, I watched your videos about investing $1,000, $5,000, $10,000. And you said, Ian, in those scenarios, you wouldn't buy too many stocks. You might buy 1 to 3 stocks, maybe 4 stocks if you're up at 10,000. And Ian, if I do my math, $10,000 divided by 4 stocks, that's 25% of your risk, $2,500 in each stock. So if I had a portfolio, let's say of $100,000, and I did a down payment of $25,000 on a single family home or a condominium, Ian, is that not the same concentration of risk as you were talking about in your other videos? In fact, it's not. And here is the very important reason to understand. When one buys a blue chip company, one that has a market cap that's in the tens of billions of dollars, those companies have many product lines. They have many products. They're oftentimes in completely different industries within the same company. I like to look at some of these companies as mutual fund type investments in their own right, because these companies are so big and they're in so many industries that if any one of their products fails, they have others that pick up the slack. And so that's why with a $10,000 portfolio, I'm okay concentrating 25% of my risk hypothetically in one stock, because that one stock represents so many different things. But here's where the concentration of risk comes with a single family home or a condominium. One is literally betting 25% of their portfolio, let's say hypothetically in this example, on one house, on one tenant, on one thing. And so there's a lot that can go wrong. It's a lot of concentration of risk. It's a different kind of concentration of risk than one might experience with a world-class, big, blue chip, dividend-paying stock. And for that very reason, I go back to my original point. If my portfolio were not in the hundreds of thousands, let's say 200,000-300,000 range, I wouldn't even think personally about dabbling in that type of investing, just because of the concentration of risk is huge. Next point. I think it's important to continue the last point, actually. This goes back to scale again. There's a lot of concentration of risk in real estate when one buys, let's say, one single family house, or maybe 2 or 3. One is literally placing all of their eggs in the hands of those tenants. Maybe there's 1, 2, 3 tenants. What if your tenant loses their job? Sure, they might move out and then you can get someone new, but there's churn there, there's downtime, there's repairs every time someone moves out. There's the cost of getting someone new into the house. Sometimes people might not want to leave. They may not have the money to pay you, but they also may not want to leave. There's all kinds of things like that that could come up. Now, if you're at the scale where you could own a portfolio of real estate, let's say 10 single family homes or condominiums, in that case, I would say there's a big difference between having 1 and 10. And so if one were at the scale where their portfolio could allow for 10 single family homes It's a completely different story. It's a completely different mitigation of risk. And that would be something that would allow me personally to sleep well at night, knowing that my risk was really well diversified. But if it were just like one or two, that's a lot of risk. So what else? Let's talk about returns. Potentially, one could experience much better returns with the route of going into real estate directly versus going through a real estate investment trust. Real estate investment trusts that I look at are publicly traded. They're big. They have market caps in the billions. There are many investors in them. They have many properties. They've created a lot of value. Because of the value that they've created, the share prices are high. The yields are pretty good, but they're nothing like one might get if they get a real good deal on a direct real estate buy. And I believe that the market is absolutely inefficient. That being said, it's efficient to an extent. And the extent of the efficiency pushes real estate investment trusts, publicly traded ones, at a level that minimizes returns as compared to the direct route. So if one wants to be scrappy, one wants to go direct, they may experience better returns. There's a few reasons for this. One, if one times it right, they can pick the right micro market. There are micro markets throughout the United States and the world, pockets of growth that show a lot of promise. If one can get into one of those markets, I believe that the San Francisco Bay Area is one of them, they may experience superior results over the long term. There's opportunity to do work with one's own hands to improve the investment. So let's say someone buys a single family house that needs some work. Let's say a lot of work. Let's say you're really handy. You spend your nights and weekends fixing it up, extracting value right there. You can charge much higher rents and also create an asset that's worth more money through your hard work. Going the direct route, one can take out a loan. So there's this element of leverage. In the stock market, someone can do that too. It's called margin. I typically stay away from margin. And in the real estate realm, though, it's pretty characteristic to take on a loan to buy a home or to buy condominium, even if you're an investor in commercial real estate. And so by taking on that loan, it gives leverage, which means your returns could be greater, a lot greater. It also creates a more risk, but there's ways to manage risk and leverage by not taking on too much leverage. What else? When one invests directly into real estate, there's this opportunity to depreciate the asset. What this means is on one's tax return for their real estate holding, the value that they buy it at, they can actually write some of that off each year over time as depreciation. Now, I am not a licensed tax advisor, so I don't want to get into this topic very much, but if one is going to go directly into real estate, this is certainly a topic to discuss with one's qualified tax advisor, and I would try to pick a tax advisor who has a lot of experience in real estate. So certainly going directly, there's a reason people do it. There's a lot of value in doing it. There's a reason why I do this as a career. But the scale I do it at is pretty large because I am a partner at a company that has 40 years of history behind it. And it's a company that owns larger properties with many tenants, both in the multifamily housing apartment industry and also in the self-storage industry. And so that mitigates risk because there's many, many tenants, many properties. But when one, and that's how I approach it, but when one approaches it on their own and they're not part maybe of a partnership, it's more difficult. And that brings me to another point. Alternatives. Let's say maybe one's portfolio is not at that level where it can stomach a few of these investments. It's going to be too much concentration of risk. One may want to consider a partnership. Are there like-minded investors in your community who might invest in real estate and might want to shoulder the risk together as a partnership? That could be a very interesting way to approach it. Maybe one approaches it the way I did by pursuing real estate as a career. Maybe finding a role at a commercial real estate development company where one has opportunities to get involved from an equity standpoint over time. And maybe even the opportunities don't come right away. That's okay. Maybe it's something that one's position grows into over time. It's all about that career path that one gets onto. And then obviously the other alternative is real estate investment trusts or REITs. One other, though, scrappy way I'd mention as an alternative as well is, and this is where I think concentration of risk is different, everyone needs a place to live. Everyone needs a roof over their head. This is a debate I don't want to go into here, whether it's better to rent or to buy. It's a personal choice. I think there's pros and cons of both. I tend to side on the side of buying, as long as one buys within their means. One does not reach for the sky and buy something well above their means. Now, the beauty of buying is eventually one gets flexibility, or even immediately. Let's say one buys a home that's too big, a little bit big on purpose. One could rent out part of the home. Maybe there's a basement, maybe there's a in-law unit. Maybe there's no in-law unit, but one takes the time to get it permitted and to create an in-law unit on their property. These could be opportunities to flex your own home to earn some income. And so that's a scrappy way to get into it. Another opportunity is, let's say one's a high earner. Income's going to go way up over time. Get into a home now, again, within one's means, knowing later that one is going to upgrade, but hold on to that first home and turn it into a rental property later. These are some scrappier ways that I think mitigate the risk to an extent that work really well, I would say, for many investors. Some other points I want to talk about. There's a lot of complexity in the world of real estate. The more I spend time developing properties, the more I realize all of these nuances, not only in development, but in management. If one wants to jump into the direct management of real estate and ownership of real estate in terms of generating cash flow, there's a lot of overhead. One has to collect payments. One has to fix the property. One has to market the property. One has to keep it in good condition. One has to handle churn. Let's say someone leaves, you have to get someone new in the property. All of that stuff. One has to keep tabs on the property. One has to inspect the property. One has to answer calls about the property if something goes wrong. You have to ask yourself, are you ready for that? And I think for one home, it may not make sense. It may not be enough scale to warrant the mind share that would go into doing that job. But if one had 10 homes, maybe that mind share would totally be worth it. It would be different. This is where it really comes down to scale. So, as a closing point, I would say real estate is also a lot about timing. In this market right now, especially in some of these micro markets that are doing really well, the major hubs, the major cities, geographical areas, prices have gone up a lot. One has to decide, have the prices gone up as high as they're going to go? Are they going to come down? Is there going to be a correction? Or is it just going to keep going? Everyone has to answer that question for themselves. I tend to proceed with caution right now, because we've been on a bull market for a long time, both in stocks and real estate. It may just not be the right time to get into buying real estate directly, or even REITs for that matter. And this is something I've discussed in my real estate investment trust video as well, I think. Just be cautious of market timing as it pertains to real estate or any other investment that one may partake in. That being said, I really want to close out here today respecting this question. It really hit home, and this is why I personally answered this question first. Even though it was one of the really recent questions, and I have a big backlog of questions, just because this question really is a personal passion of mine. I really enjoy real estate. I understand the passion why so many people want to get into real estate. I think in investing in life, one should pursue their passion. And there's multiple ways to get involved in real estate, whether it be real estate investment trusts or going directly. And it can be fluid. Maybe real estate investment trusts work now, but in a few years' time, maybe it's time to go direct. And look, I have read stories of people online who have gotten scrappy, gone all in, taken the risk by just going with one single family residence and then building from there, and it's worked for them. It's not me, it's not how I approach things, but I want to respect that viewpoint as well, because people who have taken calculated risks in life have done well. We all have one life to live. And if none of us ever take any risks, is that the right life to live? And so these are all questions that I would personally consider when approaching this very topic. One last nugget of information that I just have to mention. If one is going to go directly into real estate, buying single family homes and condominiums to rent them out, I personally would stay away from communities that have a homeowners association. The reason for this is a homeowners association can really dictate a lot of things, and they may not want you renting it out. Even if it's allowed in the bylaws to rent it out, they may get in your business, they may make it difficult, and so it may just be better to approach a home. And look, this may completely rule out condominiums, because I imagine most of them, if not all of them, have a homeowners association. So it may make more sense to go the single family home route in communities that don't have a homeowners association. Again, I'm sure there's people out there investing in homes to rent them out with HOAs, but again, it's just not my style. It's not what I would do, and I'm not trying to say anything bad about an HOA. I think HOAs can do some really wonderful things. I'm just saying in HOA specific communities, it just adds more complexity. And with anything in life, I try to reduce complexity. The older I get, the more I realize it's all about focus, streamlining, making it easy, and going for the big wins. My name is Ian Lopuk. I'm from ppcian.com. If you enjoyed the video today, I please ask you to like, to subscribe, to comment. It would mean the world to me. It's the greatest way you can thank me for producing this content here on YouTube. Also, a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. It is just for your fun and entertainment. If you are going to go out and invest capital in real estate, in the stock market, anywhere else, please do consult a licensed investment advisor first. Also, today's video is not tax advice. I'm not a licensed tax advisor. If you need tax advice, please go out and find a licensed tax advisor. Thank you so much for watching. I will see you in the next PPC Ian investing video.